Guys, we are busy preparing the cash flow statement. Okay, so now, what makes up this cash flow statement? In fact, when we hear the term the cash flow statement, some of us immediately go into a panic. Don't fear. Remember, you've worked hard throughout this entire year, and now you're just going to do your best. Are we sure about that? So stay with us and watch this here. Right, so the cash flow statement consists of the face of the cash flow statement, okay? You've seen that many a times. And it consists of notes, certain notes that you have to prepare. Right, okay. When do we do all of this? Obviously, you are going to first prepare your income statement for the current year and the balance sheet for the current year. Once those two have been prepared, the next statement that you will now prepare will be your cash flow statement. Right, okay, but now, what do you need? Obviously, it's not practical for them to ask you in an exam to draw up an income statement and then a balance sheet and then ask you to do a cash flow statement. That would take hours. So what happens now? Watch. You are given the current year's income statement, okay? Then you are given the current year's balance sheet and notes, and the cash flow statement, guys, is all about comparisons. That's what it's all about. Comparing. What are we doing? We're comparing one year to the other year. The beginning of the year and the end of the year. That's so it's last year's balance sheet compared to this year's balance sheet. Okay. And therefore you can see the previous year's balance sheet and notes. So when we're referring to this, we're talking about the balance at the beginning of the year, which would be last year's balance sheet, and the balance at the end of the year, which would be this year's balance sheet. All of that, information taken from all of that, would result in my cash flow statement being drawn up. Okay, yes. So not too bad, isn't it, at this stage?
No, not
right.
Too bad yet.
Brilliant. Okay, now let's get into the meat of it. Now we're starting with the actual cash flow statement. Where do we start off? With our net profit before tax. Where am I getting this information from? Watch my slide. You can clearly see that I'm getting my information from my income statement. Okay, but if it's not there, it's a question mark. What do I do? Freak. No, you don't. Relax. Because all that you now do is you reconstruct your appropriation account.
Okay.
And we've done that at length, so you know exactly how to go about preparing an appropriation account. From there, if it's not given to you in the income statement, then certainly information will be given to you whereby you can reconstruct the appropriation account, and in that figure, you can get your net profit before taxation. Clear, guys? Brilliant. Okay, now what do? Once we have that figure, we add back. What do we add back? First item, depreciation. Why? Why is that? Why do we add back depreciation? Because depreciation is what we call an imputed expense. Big word? No. Imputed expense, an expense that does not affect the flow of funds. Here's my brilliant calculator, which I purchased at the beginning of the year for 1,000 Rand. What's the value at the end of the year? It depreciated. It's now only valued at 800 Rand. 200 Rand is my depreciation.
That makes sense. I understand it. It
Got
doesn't
it.
affect you. Yeah.
Exactly. Did I call Nonklankla in and say, yes, 200 Rand depreciation?
No.
Certainly not, guys. Okay, so therefore, we're adding back depreciation. Why? Because it's an imputed expense. It's an expense that did not affect the flow of funds.
Yes, there was no flow of cash there.
Absolutely. Brilliant. I wish you were in my class. Okay, right. Secondly, I'm going to add back my interest expense. But now it raises a bit of doubt here that interest expense, surely I'm paying the interest expense. But remember, your interest expense is not an operating expense. It's what we call a financing expense. Got that? And because it's a financing expense, we're going to add it back here, but we're going to subtract it somewhere else on the face of my cash flow statement.
Oh, yes.
You see that? So already you can see, I'm adding back my depreciation. Simple, because it's a non-cash item. But I'm also adding back my interest expense. Why? Because I'm going to subtract it somewhere else on the face of my cash flow statement. So therefore, they are added back, but for different reasons. Where am I getting this information from? From my income statement or from other information?
So why do we get it from our balance statement?
From the balance sheet?
Yes.
Yes, you could get some information from your balance sheet. So therefore, you got to check that sometimes maybe depreciation is given to me not in my income statement, but in note number 3, which is my tangible assets note. So be careful. Don't take for granted that it's definitely going to appear here. You need to have your wits about you when you're working with accounting. Right. Okay, now, the next step. Once we pass that stage, we're now going to calculate our changes in working capital. Right? And now, what do we look at? We look at changes in inventory. Okay? When your inventory increases, it means there's an outflow of funds.
Yes.
When your inventories decrease, it means there's an inflow of funds. Okay? You also look at your trade and other receivables, same story. When your other receivables increase, there's an outflow. An outflow means money is leaving the business. Right? When there's a decrease, it means there's an inflow. Now remember, when you're doing your trade and other receivables, check. Look at the composition of trade and other receivables. See the breakup of trade and other receivables. Always remember that if it includes SARS income tax and it has a debit balance, then exclude it. Why? Because it has its own note. That's the only reason. So therefore, when you're looking at your trade and other payables, remember, an increase here is an inflow of funds and a decrease is an outflow of funds. What are my exclusions? I exclude my SARS income tax and I exclude my shareholders for dividends. Clear? Right. Now, you want an easy way to remember all this, don't you?
Please.
So I'm going to teach you some French today. French in accounting? Certainly, my dear. Watch this. Look at this word here. Pronounce it however you want to. I normally say ayulir. Right?
Okay.
To make it sound nice. What does it mean? It means that when an asset increases, we are utilizing funds. Can you see that?
The terminology that you're talking about earlier on.
Absolutely. When your liabilities increase, you are generating funds. Okay? So remember this acronym. Apply it when you are working in the cash flow question. Right. Now, another important hint. Look at the U. It tells you when you have a U, it means immediately that the U tells you that that figure must be in brackets. But we'll get back to that just now. Then we have the second one, which is exclude. When an asset decreases, we are generating funds, and when a liability decreases, we are utilizing funds. So, grade 12s, if you want to know more about this, don't stray or go away. Stay with us.
All right. Thank you for that one again, Ashraf.